Okay. Hello, good afternoon and welcome. Thank you very much for joining us today, wherever you may be in the world. The goal of this e-seminar is to see if we can advance our understanding on how ESG will impact the asset management industry, and perhaps even start the process of providing metrics for measuring the impact of ESG on fund managers and conceivably also at least their major service providers. My name is Simon Osborne. I'm the editor-in-chief of IFI Global, and this is a topic that we've got into in a very big way in the last 9 months or so. And we held a very interesting and well-attended event on this topic in New York just before COVID-19 came along. And we have re-engineered one of our 3 publications to specialize in the impact of ESG on the asset management industry, called the Briefing Report. That effectively launched back in January. For those of you who don't know us, IFI Global is a research and media house based in the City of London. We specialize in structural issues on the alternative side of the asset management industry. And we have 3 monthly publications, of which the Briefing Report is one. On the panel today, we have Aminder Dhillon. He has 29 years experience in both public and private markets at firms like M&G and the specialist ESG asset manager, Impact Asset Management. Aminder is speaking in a personal capacity today, but he serves as senior advisor to the Global Advisory Board of IC Research, an investment consultant intelligence platform, and is a trustee of a UK charity called Facing History and Ourselves, which has been set up to fight racism using the lessons of history. Chris Addy is CEO of Castle Hall Diligence, and he is based in Montreal, although he's coming to us today from Yorkshire. In Montreal, he leads a team of over 80 people who do due diligence for more than 100 institutional investors around the world on ESG and on operational matters. And we have Dr. Bob Swarup, who is an expert on macroeconomics, investment strategies, and on alternatives. He has sat on numerous industry and investment boards and advises a number of local authorities in the UK on investment issues. He's also a regular contributor in the media and an author of several books. So what I'm going to do today is ask the 3 of them to give a brief, broad introduction on the main theme. And then we have a series of questions which we will go through, and I strongly encourage anyone who wants to participate in this discussion. Just please go to the Q&A box at the bottom of your screen, fire in the questions. I would ask you though, if you are going to send a question, please do keep them short. It's much easier for me to get to if you keep them short, and I will endeavour to bring in as many questions as possible. We won't formally stop for questions, so send them in when they occur to you, and I will try to get to them when I possibly can. Right, so the big broad theme of this particular Zoom event is how will ESG impact the asset management industry? I have a strong view that it hasn't really impacted it really very much, if at all, to date. That I think is going to change, and it might change quite quickly, and that's really what we're going to get into in a few minutes. Where should we start? Maybe we should start with Chris. How do you think, in broad brush terms, before we get into the details, ESG will impact asset management practices going forward?
Well, first of all, again, thanks, Simon, for the chance to participate. Yes, I'm here in Yorkshire thanks to COVID, but hopefully we'll return to Canada in due course. I think that ESG is going to have a profound and pervasive impact across the industry. It really struck me before COVID really got going that we were coming into a new decade. And I think the 2020s, by the time we get to the end of this decade, it will be a very different landscape for the investment management industry. and really the sense of transparency, accountability, and linkage between the asset manager and the asset owner. And clearly, with COVID, with the tragic events around in the United States and the reemergence of Black Lives Matter, just immediately such a strong pressure to really confront and evolve our thinking around a variety of ESG issues. But I think ultimately the sentiment and perhaps distinction that I would make is really for us to think more deeply about whose money is it. So I spend a lot of my time working with sovereign wealth funds, large public corporate pension plans, and the relationship is oftentimes between the asset manager and that organization, investing organization. Well, in the first instance, the asset manager is a supplier, a vendor to that asset owning organization. So really it's the supply chain. Who am I doing business with as the asset owner selects a roster of potentially way more than 100 external asset managers? But I think it's also very important to think about the end beneficiary, the client, the end owner of the assets is not the investment team at the sovereign wealth fund. It is ultimately the tens of thousands, hundreds of thousands, potentially millions of retiree asset owners or asset owners in the path to retirement. And their sentiment, engagement, and sense of significance that they're giving to ESG matters, I think, has really increased and will continue to do so. Super quickly, a great example is in Australia with the superannuation industry. If you're as a super, you need to compete in the marketplace to get new members into your organization. So as your elder cohort retires, you need to have younger members at the beginning of their working careers. Any super fund that doesn't have a product and offering where ESG is central to the overall value proposition of why the money should be invested there simply will not be successful in this decade. So I think there's going to be some very profound changes, and we're fundamentally into a different investing environment.
Thank you. Bob, can I come to you? What do you think, in broad brush terms to begin with, will be the impact of ESG on the asset management industry? You can see it both from like Chris, from the investor side and indeed from the manager side.
Sure. Well, Simon, listen, thank you for having me on. I think, look, the impact we know is broad. We know the impact is dramatic. But what I'd probably say is the impact is probably yet to be actually felt. And what I mean by that is where we are today at the moment is what I would term is in a world of peak ESG. And what I mean by that really is that we are very, very woke these days. We care a lot about inequality, we care a lot about the environment, we do a lot of hand-wringing. We're effectively little champagne socialists in a sense out here. And if I have to describe the state of ESG today, it reminds me of benevolent societies in the 19th century, where you had ladies who gathered around tea parties and agonized about the poor and the deprived of London, threw a few little coins at them and then ran away to have some more champagne and tea. And we're kind of in that stage right now. And that's why I call it peak ESG, because in reality, we haven't really delved into what the essence of ESG is and what it really means. And ESG fundamentally to me is really about rethinking what is the relationship between capitalism, in this case asset management is one adjunct of it, and society. Because fundamentally capitalism has always been around for thousands of years, but it never really became successful till democracy came along. Because you had this wonderful kind of bargain where you said, look, I'm going to give you millions and millions of consumers who are going to buy things, and you're going to produce things for them to buy. And between the two of them, we'll make a great partnership. And that worked because capitalism got a huge market, and democracy, by the way, got a redistribution mechanism, hopefully, that allowed democracies to spread that wealth out further. As society evolves, though, capitalism and the fund management industry is a sort of reflection of that, needs to evolve as well. And that's where we are right now. I think the danger where we are today is that we will talk a lot and do very little. We will tell ourselves that we are deeply, deeply woke about everything, but it will again do very little. And importantly, that we will become extremely reactive. It's already interesting, and I'm sure we'll touch on this in our discussions, that the E has suddenly fallen away and the S has become very important in the aftermath of Black Lives Matter. It'll probably shift again, by the way, in a few months or a few years when something else happens. And that's the problem. We are being reactive. We're not being proactive. And that's extremely important because also the industry cannot be all things to all people. It has to identify what it's trying to do in the long term. because that is what is essential both for achieving anything of note in this regard, but also for the industry's own longevity.
Thank you very much. And Aminder, can I come to you, and welcome to our events. It's nice to have you here. Can you start, as I said to the others, with some broad brush comments on how you think ESG will impact the asset management industry? And I was very interested that you've got the experience of working for, can I call it a boutique shop that specializes in this area, and a ginormous global asset manager in M&G. Over to you.
No, thank you, and pleased to be here. I don't think I'm going to disagree with anything that Chris and Bob have said so far, so let me just try and sort of flesh it out a little bit, if you like. I think, you know, Bob's right that there's been a lot of signalling around ESG. My fear over the last few years has been, well, I hope it's not just about just trying to create product to gather more assets, but without really looking at fundamental business processes. And that's the danger of some of the greenwashing that's there. I think essentially part of the reason there's a lot of talk. There has been some action over the last few years in terms of what goes on in portfolios, but the more fundamental changes about what ESG means haven't happened. That's because they're very difficult. So things like, if you look at sources of profit for a fund manager, it took, for example, the FCA to outright ban the issue of box profits in 2019, where certain managers were making risk-free profits out of the bid-offer spread in trading of mutual funds. But it took the FCA to, as recently as 2019, to ban that practice. And so I think that speaks to why managers have yet to really look at how ESG applies to their own business practices. And that's what really needs to happen, because one thing is saying, well, we've excluded certain stocks, or we make sure the companies we invest in have a relatively high ESG score. But how does that play to the integrity of your product management process? How does that play to the share of the return that you're taking in terms of fees? How does that play to, are the sources of profit in your business fair and transparent? How are you working with your own suppliers? How are you treating your employees? I think these are the issues that, unless it's just going to be about virtue signaling, these are the things that I think asset managers are going to have to tackle. And we all need to do it hopefully, as a process. It's a non-judgmental approach, I think, is the best thing for the industry as a whole, because for sure there will be practices going on right now that once you expose them to the sort of cold light of day, probably don't cover anybody in glory. So I think that's where, yes, profound changes. Yes, we're at a sort of a peak ESG marketing chat in Bob's terms. But I think we really need to see it progress into how companies do business. And you are seeing investment consultants, for example, the sort of gatekeepers of capital, looking at things, and hopefully we'll discuss this as we go on, looking at things like investment manager culture. And there are some specific angles they're trying to understand and incorporate into their ratings about where they decide to allocate capital. So I think we're only at the beginning. If we're moving past virtue signaling, we're only at the beginning of what it means for the practice of fund management.
Thank you. I'm encouraged that you've all, in your own way, basically said something similar about we're at the beginning, there's a lot of virtue signaling going on, and so on and so forth. And that's what we're going to try and do today. We're trying to get beyond that particular point where I think we're all agreed that we are. So I'm going to go straight into probably the most critical question of all, and then we're going to sort of perhaps drill down and talk about it in more practical terms as we go along. And here's that question. Is there a way of scoring or rating, not ranking, in deference to a bit of a chat we had in the prep call, but certainly potentially scoring or rating or benchmarking ESG standards or capabilities, ESG capabilities of fund managers and potentially of their major service providers? Now, we're not going to sort of solve that right this very second, but do you think, gentlemen, that this is something that that could be done? And if it could be done, would it be of benefit potentially to investors, assuming it was done well and professionally? And would indeed it potentially also drive higher ESG standards of managers? Who wants to take that first? Perhaps I'll come to you first, I mean, since we came to you first time round. What's your view on that?
So can managers be assessed? I would say yes. We see, as I say, to turn to the investment consultants, they're doing it on, essentially they're looking at ESG practice as it applies to the investment process. And there's still work to be done there, because I think, you know, if you go back 5 years, investment managers, you know, probably the typical view was, well, I need to do something about ESG. I must tick a box. Let me hire a few analysts, stick them in the corner, call them the ESG team, and job's done. The investment consultants got wise to that, and they're looking at how is it integrated into the investment process, not just whether you've got nice, pretty analyst notes written on it, but in portfolio construction terms, what has that analysis actually done in either your weightings or what you've chosen to own or not to own? And there's still work to be done in that area. So, and one can definitely get a pretty solid handle on that just by doing this, the sort of normal due diligence of an investment manager and their investment process. So that's sort of one aspect to it. Organizations like Share Action look at how managers are voting, and they relative rank the managers on whether they are being good stewards of the client's capital in terms of exercising voting rights. Although I think there's still work to be done about trying to make voting possible for clients within pooled funds, where those clients can express their particular voting preferences, which we're not there yet. The other area that you can assess is how the manager goes about doing their business. Now, that's at an earlier stage, and it's pretty difficult. But I think there are things like sources such as Glassdoor. There is data such as staff turnover. There is data such as absenteeism. There is data such as, are you paying your cleaning contractors as a fund manager? Do you make sure that the contractors you employ pay those cleaners a living wage? There are ways in which one can interrogate it. It's not straightforward, it's not easy, and it's a lot of work. But I think one can dig into how the manager goes about doing their business, and certainly things like fees, the share of the performance that you take in fees, are knowable in advance. And can be done a lot from desk research, but there's a lot you have to go into the leadership team and down the levels, because I think one of the aspects is you can get a good story from talking to the board, but how deep does that story go once you start talking to the different management levels? Is everybody on the same page, culturally speaking, in terms of how the manager goes about doing its business?
Bob, can I come to you? What's your view on whether or not there is a way of bringing in the kind of topics the minister has talked about? Even I'm fascinated by the example of even the cleaning contracts, going into that level of granularity. Is there a way of bringing this all together and coming up with something definitive that would be credible, that could be used for maybe for the benefit of public pension funds, some of the maybe the local authority people you work with, and indeed any other types of investors, that would be a sort of a conceivable benchmarking of asset management industry standards? What's your view?
Look, I think you have to come up with some sort of standardization in due course. I mean, to Aminder's point, there are many, many different areas you can delve into. I think what you can see, by the way, from the experience in the corporate world, where many of these issues have been issues for much longer than they have been in the asset management world, it's not easy. I mean, the example I always think of is the Norwegian government pension fund, which of course, is one of the premier kind of ESG investors in the world. And about 3 or 4 years ago, they found out that they accidentally had managed to get hold of $1 billion worth of exposure to the state surveillance industry, mainly because of their investments into companies that made little components and parts of the supply chain, things like that. And that's a real problem, because if you look at what's happening with Boohoo right now, things like that, the supply chain itself is quite complex, and asset managers actually tend to look a lot at that. I mean, as in a simple example, we're talking on Zoom right now. Well, guess what? If you go to India right now, Zoom's one of the apps that's been banned in India, along with TikTok and a whole bunch of others, for worries over whether the Chinese have access to, some of the data on it or not. So, these are going to be tensions that are going to be coming through in many, many different ways. That doesn't mean you can't find a way of standardizing it, but I think that is a journey that will take years, not days, weeks, months. There are lots and lots of ESG data providers out there, and there's a spurious sense of quantification in my mind that goes on with that. You cannot reduce ESG down to a simple score, a simple number. I mean, I think we all love shortcuts, that's human nature. But if you look back at the birth of the ratings industry, where they did reduce credit risk down to an alphabet, which in itself sounds like a slightly bizarre notion. The fact of the matter is you had lots of fundamental analysis behind it originally. And over time, as people began to agree on what the key parameters were, you started to have a coalescence of what the different parameters came together as. And we also know, by the way, subsequently, that simply relying on the letters alone causes problems. So I think, yes, you can get there, but I think it's a journey for a few years. And, I'll leave it to Chris to talk about some of the experiences that he has. And I know he's got very particular views on, good and bad. But I think what I will say is that I think it's important to understand that regulators are probably as much in the dark here as the industry itself. Most regulators are right now demanding more disclosures around climate change, for example, or that are trying to find ways of measuring stress tests or things like that. They're actually getting these data points in order to help them inform how they regulate rather than trying to regulate. So to my mind, that need for actual discussion of collaboration is going to be very critical to any kind of future comparison.
Thanks. Before I bring up Chris in, perhaps Chris, you could answer this in your response to both what Aminder and Bob have just said, but also I'd like to throw this at you at the same time. Perhaps I can see the enormous complexity involved and being good examples just given on the investment side, because of the surveillance equipment or whatever it may be, and how do you strip that out of the supply chain, et cetera, et cetera, et cetera. Maybe a way to start would be to leave the investment side, not saying forever, but temporarily aside, and look at industry practices. And I know that you at Castle Hall have done work on industry practices, and perhaps you could talk to that, and whether you could just leave aside, not saying it's not important, it's incredibly important, but you could stop people using that as an excuse not for doing something, and maybe using this kind of surveys, questionnaires that you guys have come up with at Castle Hall to start coming up with some sort of scoring. Over to you.
Yeah, it's a really interesting question, and we had a great discussion in the preparatory call around this. In Castle Hall, we perform due diligence, so we're a diligence company, not a rating agency, and I think it sort of informs our perspective, or our point of departure is a little bit different. Fundamentally, due diligence is three things. It's, first of all, explain to me what your controls, policies, and procedures are. Second, verify and validate that your controls, policies, and procedures operate as described, so a trust but verify exercise, and then produce an assessment as to the relative strengths and weaknesses of business practices, business operations, and that could be absolute or relative to peers. And from that perspective, one thing that has been very puzzling for us is almost the obsession in ESG land for a scientific score to 17 decimal places. And there really does seem to be a sort of investors, we're sometimes our own worst enemy. We love a simple answer to a complex question. And just the difference in ratings that you see between the different vendors. There was a great article in the Wall Street Journal a couple of years ago where they took the ratings from FTSE Russell, Sustainalytics, and MSCI for 5 or 6 large companies. So Tesla, General Motors, Exxon, Alphabet, Berkshire Hathaway, yes, for those 5. And it came up that Exxon, according to FTSE Russell, had a far better ESG score than Tesla. And indeed, Tesla, all of them felt that Tesla was worse than GM. And that was both a broad variety of different methodologies, particularly around question of what you did with lack of disclosure and response to questions, and also whether one methodology took account of downstream emissions from the production of non-emitting electric vehicles, and other methodologies didn't. There's just a lot of pseudo fake science. I think your phrase a moment ago, Bob, was great with respect to that sort of fake precision. So we're skeptical about about a precise number, but the way that we've approached due diligence on ESG is really to look at this at 3 levels. So first of all, there is what is in the portfolio. So we own Exxon, we own Chevron, we own Alphabet in the portfolio. What are the characteristics of those companies? And I think that's where a lot of ESG analysis has traditionally lived, and that's of course where the rating agencies are, in terms of what is the score for Chevron, Exxon, etc. And what we've done is look at what we call the responsible investment strategy, and then the responsible investment manager. So the strategy is actually the investment decision-making process. So how does the decision-making process operate? And we're asking questions such as, to the earlier point of, okay, well, you have 3 ESG analysts, but you have 330 funds, companies on your recommended list, which means that each analyst must do about 110 a year, which means 3 per week. Do you have enough resource to do that? And then it usually comes out, well, no, the research papers are only refreshed once every 3 years, or we've only just started doing our more detailed type of research paper and it's not in place for 80% of the population. Things of that nature. And then we come back up one step still further to say, well, ultimately, what about the management company itself? What about its business practices across environmental matters, social matters, and governance matters? We also ask, of course, about claims investigations related to any Me Too type events that have led to settlements related to workplace misbehavior, really in that sense of trying to understand, well, who am I doing business with? And for our clients, we've looked at about 50 or so different asset managers and really got a very broad spectrum. It's very early days. There's just a lot of variety in how managers consider and disclose their ESG activities. But ultimately, I think the more information is gathered, at least some sense of calibration and directionality can come from that work. We like the phrase leading and lagging. So who is certainly leading in a particular area and who is potentially falling behind, who is behind at a point in time and who's potentially falling further behind over time. And I think those are some, those can be some frameworks that at least help move us forward.
Do you think is that data, do you publish the data on particularly the laggards as well as the leaders? And if the answer is no, do you think it should be published?
Again, our business model at this time is performing due diligence at the request of our institutional investor clients. So they ask for operational due diligence, and we are now conducting ESG due diligence at either the strategy investment decision-making level or at the manager level. So the work to date has been private to those particular clients. As the amount of work that we do has increased, the peer group data is becoming very interesting, and we have circulated some private materials across our clients. You know, even something where you find, 83% of managers, I think was the stat, had not formally agreed to offset carbon emissions from corporate plane travel back in those halcyon far long days when we used to take a plane. But questions, how many managers do actually include ESG characteristics in their compensation mechanisms? That's a fascinating question, because we all know asset management, the buck stops with how you're paid. And we can say all of these things, but if you don't include ESG in your comp matrix, it's unlikely to be embedded and structurally significant within the firm. So those sorts of things have proved very interesting.
I want to get into social investing in a second, but I'm going to read out one question we've got from the audience, which is, since it's relevant to this part of the discussion, how successful is ESG in filtering out investments which subsequently prove problematic? For example, Wirecard didn't seem to be weighted in many ESG models. I know you've written something about Wirecard, Chris, but can I come to either Bob or Aminder on that? In general, do you think, is there a way of factoring that in or not?
Well, I think it's not easy, right? Because I think it goes back to the complexity of the supply chain in areas like that. It's very, very hard to dig deep enough to get that detail. I think there's some obvious things that people always go for, which is, as Aminder talked about, the exclusion kind of methodologies. But actually trying to find reputational risks, because fundamentally that's what you're talking about from an investment perspective, to find reputational risks that are hiding in the detail. I think you need a lot more than the 3 analysts that Chris was alluding to.
That's
find
a big team, 3.
Exactly, but that's what you need, and that's the real challenge, which is that if you don't have that available to you, then you're going to struggle to spot those risks. So I don't think that necessarily takes away the problem. I mean, I think there are probably more wirecards out there. And it's important to remember also, by the way, that the other issue with ESG, and this is probably a different point, Simon, is that sometimes these risks take years to play out. So something that looks fantastic from an ESG perspective today has a problem that's building in the background, which won't come through by the 3-4 years. And that's another problem, that kind of forward-looking aspect.
Okay. Unless you've got anything you particularly want to say to that, I mean, I'm going to move on to another area I really do want to get into, and I'm conscious of the fact we're already halfway through this discussion, which is the whole, it was touched upon at the beginning in your intro statements, is that we're in this very weird time in history with the arrival of COVID-19. And I'm going to ask you all, maybe come to you first, Aminder, is do you think it is going to, with the ensuing economic crisis that we may not really be in yet, or maybe going to go into that later this year and into next year, is that going to downgrade environmentalism? Was environmentalism a bit of a luxury in terms of how strong it grew, in the sense that, you know, are we all going to want the cheapest petrol for our cars? We don't care less about anything, or the cheapest flights, we don't care less about the environment, we just want to survive for the next few years. Meantime, back at the ranch, as has been touched upon, we've, even before the events in Minneapolis, Minnesota in May, there was already, I think, coming quite quickly up on the rails, a big growth in social investing. I think the events that have come along, and Black Lives Matter and all the other stuff, has just added to that, but and given it much more force. But it was happening anyway. Do you think, gentlemen, we'll start with you, Aminder, that we are potentially going to see investing for social ends getting up to anything like investing that we've had for environmental ends over the last few years? We'll get into the metrics of that in a minute, but over to you, Aminder.
I think it stands a very good chance to, I mean, certainly it has been growing. The UN Sustainable Development Goals that were issued a while back provided a framework that, because I think part of the challenge initially was, well, how do we assess? Excuse me. I've got my, that was my FaceTime kicking in there. Apologies for that. But I think we've got, I mean, if you look at the UN SDGs, they provided a framework that was missing, if you like, for assessing how to assess impactful investments or positive impact investments. There are a number of those sustainable development goals that focus on the social side of things. So I think this focus on social started to rise rapidly from the moment the SDGs were issued. And I think recent events have just helped to compound that. If you look at Big Society Capital's data, they look at social investment in the UK. It's grown by 30%, but it's from a very low base. So I think as the frameworks continue to get developed, investments in things like social housing, for example, where you've seen a number of REITs coming to the market over the last few years, providing an income and investing in social housing or healthcare or educational initiatives. I see all of those as rapidly increasing, to be perfectly honest, but from a fairly low base. Now, will they get as large as environmental? I think I don't have an answer to that at the moment, because I think we need to see the frameworks develop so that when clients are investing their capital, that they understand, and there are clear metrics on the impact, the social impact that the investments had. So, for example, a previous investment team that I was involved with would be investing in environmental and social impact. One of the social impact areas was student housing. Now, what they dug to the sort of next layer of detail, if you like, which was, well, it's about student housing in areas that are less advantaged, you know, and further down the socioeconomic scale, rather than student housing for the sort of sons of billionaires, if you see what I mean. So it's about having a pretty solid foundation before you start making investments of what is it that I'm trying to achieve with this particular investment, and what is the improvement or the additional improvement I expect my capital to deliver over and above that which would have been delivered had I never invested in the first place. So definitely going to grow. I think it's going to grow substantially, and in percentage terms, I think it'll probably outpace in percentage terms environmental, but that's because it's coming from a lower base.
Bob, I know you've done some work in this area. I think I'm right in saying you've been working on some bonds with local authorities for COVID-19 related issues. What are your views on the growth of social investing?
Well, I think, as Aminda said, it'll come from a very, very low base. And though it may grow rapidly, it will probably still be relatively small in the grand scheme of things. I mean, bear in mind that after all the billions and billions that have poured into renewables, we live in a world where 85% of all of our kind of energy needs are still met by coal, oil, and gas. So, you know, I think that gives you an idea of how long it might take to change things. I mean, on the social side, I am seeing a lot more change. So I think the social bonds you were referring to actually are ones that have been issued a lot by kind of people like the WHO, governments, and people like that. And the insurers in particular have become very large buyers of these social bonds. Now, to be fair, they're doing that because similar to the old renewable bonds, these are in effect, you know, them buying government-backed cash flows that they see as being pretty secure with a half-decent yield attached to it. What I am seeing also, though, which is where we've been doing some work more recently with local authorities, is we've actually been involved in setting up a social impact fund, which has been sort of started by about 5 or 6 local authorities, as well as another fund which is based in London that is actually looking at local infrastructure and, again, investing in society. Now, these are interesting because they show an attempt by institutional investors to blend what is effectively, you know, key kind of development or statutory objectives with financial returns. And I think it's an experiment is how I would describe it at this stage. You know, on one hand, you know, you can see some clear opportunity sets. You can see the good that can be done by bringing the money to those opportunity sets, but then trying to measure that social impact over a period of years is actually the key challenge. So for example, if you go into affordable housing, well, that's relatively easy to measure, and that you can talk about how many houses you built. But for example, 3 or 4 or 5 years on, how many of them actually have done what they intend to do? I mean, a very good example, going completely to the other end of the world, is Singapore, which actually had an extremely successful affordable housing program to the extent where the demand for those properties went so sky high afterwards that now to buy an apartment in one of these affordable housing blocks will cost you about $700,000. So slightly away from the affordable housing bit to being back to unaffordable. You know, so there is a problem there. You know, similarly, if you look at things that are around, say, supporting businesses or job creation, you run into pretty complex areas, which is, for example, if you support a business, you know, is that business a viable business or not? If you're talking about job creation, are these people creating jobs and keeping them just for the next few months, as we're seeing, for example, with the you know, kind of job retention scheme, or are they actually creating jobs that are sustainable for the long run? So I think there's some challenges there, but it all goes back again to trying to figure out how do you blend what are essentially development objectives with financial ones.
What's your view, Chris, on social investing? Do you think that we could be on the cusp of, maybe not on the same scale, because as Aminda said, it's coming from a very low base, and Bob said that too, but nonetheless, do you think we're going to see a lot more social investing, however it's defined? I realize it can be defined in various different ways. Is this, in other words, put this very bluntly and simplistically, could this be the next bandwagon, the investment craze, in the way the environmentalism has been an investment craze? I think we'd probably all agree to that over the last few years. It's been a great thing to invest in, and the hope for renewables, isn't it wonderful? Are we going to be seeing something on a similar scale for social investing?
The cynic in me, Simon, would say that the UN had a masterstroke when they created these sustainable development goals. They created I think it was 16 or 17 very pretty icons. So anybody in their marketing material can say they're following certain SDGs, and it looks wonderful in the marketing deck. No, I really think it's more of a catch-up to avoid an overemphasis on the environmental side, which clearly, particularly because of the Paris Treaty, was both measurable, contemporary, very popular, and visible in terms of its political activism. Where I think I come at this from a due diligence perspective, you know, at the portfolio level, is thinking a little bit more about reputational due diligence. And almost flipping back to the earlier question about Wirecard, that was not necessarily a question about ESG practices at that particular portfolio company, but negative publicity, adverse media would come through very strongly from a media search and reputational due diligence. And what we're seeing at the portfolio level is just really an awareness that you as an investor don't wish to be caught, or as an institutional investor do not wish to be caught holding something that suddenly has reputational blowback. So a great example would be Boohoo, the fast fashion firm here in the United Kingdom, which is alleged to have created a shadow supply chain centered on the city of Leicester, where there were significant numbers of workers being paid far less than the minimum wage in essentially sweatshop environments, which have allowed mass transmission of COVID-19. This is an absolute classic definition of modern slavery. That is what the definition is there for. And the fact that this is a major FTSE company with a multi-billion-pound capitalization in many people's portfolios, you know, no, you have to be able to look through those issues. Similarly, over in Canada, several of the large Canadian pension schemes were criticized for holding interests in Chinese technology companies making surveillance technology to suppress the Uyghur population. Again, it's just completely contrary to the statements and positioning of the organization. And I think there's not a simple answer to this, but organizations need to look carefully and look in depth. It takes time and a lot of work to really pull together the mosaic of ultimately where is my capital deployed and is there potential reputational risk. Super quickly coming back up one layer, of course, we then have the question about, well, what about the management company itself from an S perspective? So clearly questions around gender and more recently with Black Lives Matter, awareness of, yes, we should think about diversity very carefully in terms of ethnicity and race. But even on the gender side, to be looking at how many managers have, for example, completed a gender pay gap survey. It's the law in the UK, in Australia, and actually in the province of Quebec, where we are, but pretty much nowhere else. And the one thing that I found fascinating is how many managers, a significant majority of managers, around 70% in the managers that we've surveyed, will not disclose whether they have made a settlement or terminated an employee with response to workplace misbehavior, be that sexual harassment, racial harassment, etc. I'm very puzzled as to how a large institutional investor can deploy capital to a manager that will not disclose whether there has been a fundamental S issue at the management company level. And I think that is something that will change going forward.
I'm very pleased you actually segued into where I wanted to go next absolutely perfectly by mentioning or touching upon the focus of the management company and the standards of the management company. Because one of the things that, first of all, when I put this question to you, I'm going to make a little sort of mini speech here for a second before I put my question. I want to see, A, whether you agree with this. But when we've looked and done comparisons insofar as we can, and I appreciate it's very difficult to see, how the asset management industry performs relative to other international similar industries. For example, management consulting would be one obvious example. It does perform very poorly. Here there's a potential element, or more than just a potential element, of significant hypocrisy, because these are the same asset managers who've raised all this money through brilliant marketing for their ESG funds, gone out and they're lecturing corporates around the world about what their standards of behavior should be in order to get allocations for these ESG funds that they've raised off witting or unwitting investors. Yet when you look into their own practices, it's really pretty poor. The one obvious and immediate example I can cite for those of you following this webcast is the Refinitiv D&I, which stands for Diversity and Inclusiveness Index. And I think I'm right in saying there is only one asset manager in the top 100 companies on that list, and that's BlackRock. There's certainly only one in the top 25, that is for sure. But then very similar firms, Accenture, I think, was top. It's not particularly different in type of business in some respects. So why is Accenture doing very well and other sort of consultancy, global consultancy operations like that do very well as well as Accenture? And why are asset managers doing very poorly? And I would also add to that, before I hand it back to you three, as many people following this webcast will know, last year in the UK, the UK asset management industry was mandated by the FCA to put 2 independents on boards. That was a really good opportunity for them to freshen up their boards. They're bringing in outsiders. They could have done an awful lot of interesting and different things with those appointments, but they really failed lamentably. And one of our researchers looked into the composition of those boards. This is very early on this year, and saw that still not even in something like a third of the cases any women on the board, let alone any other form of diversity. So my first question to the three of you is, A, do you agree that the asset management industry is behind? And B, is it being hypocritical? C, if the answer is yes and yes, what, if anything, can be done about it? Who wants to say that loaded series of questions first? Maybe I should come, you, having worked in a number of asset management houses, Aminda, I think I'm going to throw that one at you.
Oh boy, okay, so tell it like it is, Simon, that's what I say. So here we go. I mean, are asset managers being hypocritical? Certainly some are. I would hesitate to say all of them, because I think some are really trying to make, best efforts, but they are in the minority, I would say. I think when you look at, and I mean, this goes back to, I guess, where I opened up in the opening remarks, is that I think a number of firms have seen ESG as a product solution problem. I need to create some products because, that firm over there is doing some ESG and they've raised loads of money. And I'm hearing more about it, I better launch some products and raise some money too, otherwise I'll be left behind. And it's remarkable, that how very few of them see that ultimately, if you have any daylight between what you're doing in portfolios and what you're doing as a business, there are a whole bunch of NGOs out there on planet Earth who look for those gaps. And now, I mean, you mentioned BlackRock, so let me pick up BlackRock, for example. I think it was BlackRock, pretty sure this is correct, that about 2 or 3 years ago, in its tracker funds, was found owning companies that were part of the cluster mine supply chain. Now, and what happened? What happened is a bunch of wealth managers straight away exited out of their tracker mandates with BlackRock, and then I think it was BNP Paribas that was tracking an index excluding cluster munitions, picked up business. So I think there's a lot of managers have seen it as a product problem. Even when they've seen it as a product problem, they've not always addressed that particularly well in terms of integrating ESG. Very, very few see it as something where they need to, is the share of fees we're taking out of a product fair and reasonable? are we making profits from areas that our clients wouldn't expect? I mean, two examples. I mentioned box profits earlier on, but a second example of a manager, I'll remain nameless, but where essentially they'd outsourced their middle office and back office. And so this outsourced agent was providing transfer agency services to the pooled funds, charging the fund manager, let's call it £5 per change in the shareholder register. But the fund manager was charging out to clients £20 now per change in the line, and making several £1 million a year just from that. Now, the manager would argue, oh, I need this as an SLA, you know, I'm overseeing the third party relationship, I need to cover those costs. Sure, but is a £15 per change markup fair and reasonable? Would you want that appearing in the Daily Mail, my Daily Mail test? If that information was published in the Daily Mail, could you happily defend it and make the case for it to your clients? And there are a number of these practices that go on in the industry that I do not think are defensible. Treatment of, I mean, we have a tremendous amount of virtue signaling in the investment industry about well-being and staff well-being. And then when you look at some of the compensation practices, just picking up Chris's point, they're incentivizing behaviors that would act contrary to certain, fairly well understood notions of well-being, and good practice, if you like. So there's all these things going on where, the industry will say one thing, oh, we're really interested in the mental health of our employees, and culturally behaving in a way that is completely antagonistic towards that. So there is a lot of hypocrisy, I'm afraid, but this is ultimately some of the reputational issues that, Bob and Chris have talked about. They will get flushed out. Absolutely.
Sadly, we're really, unfortunately, this always happens where these things go far too quickly. So I'm going to have to ask you all to be fairly short in your answers from now on. We've only got about 8 more minutes. And we've got some more questions from the audience, which I'd like to try and come to if we possibly can. But quickly, very quickly, if you wouldn't mind, Bob and Chris, do you agree that the industry, this is the asset management industry, particularly at fund management group level, it could even be at fund board level as well, is being a bit hypocritical? And it'd be very interesting, for example, to look at the boards of the ESG funds in terms of how diverse they are. But Bob and Chris, is that your view? And if anything can be done about it?
Well, I don't think they're being deliberately hypocritical. I suspect they're being very woke and haven't gotten past the woke part to actually doing something about it. So, I think many of them are very unconsciously, carrying on in the exact same way they've always done. One of the challenges also, by the way, is that it's not just about diversity for diversity's sake. It's actually the intention of diversity always was to create diversity of thought. And I think it's very important to remember that. Because, look, you're doing kind of fairly decent diversity quotient for this panel because you've got 2 brown faces. You're missing, unfortunately, a woman. But the reality of it is that I would hate to be on this panel just because you needed a token brown face to kind of fulfill your quota. Hopefully, Ravindra and I are here because we actually add some value. And I think that's important because if you ask a lot of people what frustrates them, and I can tell you this from, for example, women I know, from people from ethnic communities, etc., what frustrates them is this notion that somehow they're being palmed off by being told, here you are, here's a nice box for you, well done, you did well. And the answer is no, that's like a pat on the head. I mean, if you think someone's worth it, then, you want to add value. And I think that's important. The diversity of thought, I would say, is critical.
Yeah, as the only white face on the panel, Chris, would you like to agree or disagree with that?
Well, cognitive diversity is I can't imagine running a business where you're not focused on bringing in different perspectives. I was just going to quickly give an example. I mean, ultimately, it ultimately comes down to our side as investors. We've got to get beyond the virtue signaling and actually, if these things, whatever these things may be across E, S, and G, great question about should they be separate, should they be combined. we ultimately need to make an impact in our capital allocations, in our choice of which investment managers do we choose to buy a product and service from. And of course, a great example is Ken Fisher of Fisher Investments, who back in October last year was at a conference where he made a range of generally considered sexist and derogatory remarks about the state of the industry. And that led to him losing about nearly $3 billion of assets from a range of very high profile investors, such as the Iowa Public Employees Retirement Scheme, state of Michigan, Boston Retirement Scheme. I think Goldman Sachs also pulled some money. But if I look at Fisher Investments ADV filing, at their 2019 filing, March the 26th, they reported regulatory assets under management of $94.1 billion. At March the 23rd, 2020, which was 5 months after these events, they reported regulatory assets under management of $120.9 billion, which was up by more than a quarter. So that clearly didn't have an impact on capital flows, whether that was retail or institutional, I'm not quite sure. But I mean, ultimately, do these things matter or not?
Right. We've got literally seconds left. I'm going to try, I'm going to read out two questions. If you can give to both of them, they're very different questions, very quick answers. Here are the questions. Any thoughts on the proposed EU mandatory ESG reporting for funds and institutional investors in the draft RTS currently under consultation? And then the other one, there is a tendency, including amongst this panel, to discuss E and S and G as separate topics. And actually, you just touched upon that yourself, Chris. However, E subsumes S, and both E and S subsume the consideration of G. Does the panel think that this observation is right and that the industry realizes that? Can you do justice to those questions in seconds in reply?
I'll take the first one on the EU reporting. I think it is a helpful taxonomy, but it is likely to have quite a few people who disagree with elements of it, both on a regional basis as well as on a more methodology basis. So I think ultimately it will be a tool in the toolbox, which is relevant and available from issuers who are active in Europe. But it is not that this is not one size fits all, and it will take time for any form of global standard to emerge. There's so many different standards: PRI, SASB, GRESB, many different things coming along.
Bob, you and I have spoken a lot about potential, how we should be looking at governance in the ESG, and I think you made the point many times that it's kind of not looked at enough. Would you like to quickly answer that other question?
Yes, I will. Well, what I'll say is that to the person on the question, I actually did write an article for one of Simon's publications a few months back, which was actually called Governance, the Silent G in ESG. And so I'd be happy to forward that on to anyone who's interested. But no, governance, we don't talk about enough, and I think that's probably the next frontier. But the thing is that you need governance. It's critical to actually executing the E and the S, because we've talked a lot about boards already today. We've talked a lot about people, being woke, but not necessarily going to the next stage. We've talked a lot about, people kind of simply doing enough to do virtual signaling, but not really anything further. That all comes down to governance, and we probably don't talk enough about it. But on the other hand, I think the very fact that we're having a discussion here, and hopefully that this is not just a single one-off discussion, but the start of multiple ones, means that we can just talk a lot more about all these facets and how they come together.
Now, Aminder, I realise you have to go. You've got, I think you've got your call for departure. Before you depart us, is there anything specific you could say? I mean, is there anything in terms of practical follow-up from this discussion? I mean, it's all very nice to have these discussions from time to time, but where's the practical follow-up? Is there anything you can say specifically to that?
Well, I think in terms of practical follow-up, I think a lot of managers have made a start on ESG within their investment process, and if they haven't, they should start straight away. But I think assuming they've made that start, they should be looking at essentially a rolling process on the operation of their own business, which is what are we doing with our key stakeholders? Are we showing appropriate social responsibility in terms of employee relations, in terms of incentives, in terms of the integrity of the product development process, the fees that we charge, and the way we interact and the value proposition for clients. So I think it's essentially they need to start the process of looking at their own business and ensuring from the top to the bottom of the organization that there is sort of clear rules of the road, if you like, about what they are doing in their own business, whether that's carbon emissions and making sure that they're carbon neutral in terms of their travel, whether their suppliers are getting paid the living wage, whether their employees are incentivized in a way that's not contrary to employee well-being, and that clients are being charged fees that clients would find fair and appropriate, and there are no unintended sources of profit that would come as a source of surprise to the client. There are some starters, I think, for any asset manager that's out there.
Thank you very much. I know you've got to go. I'm going to ask Bob, please, if you need to go, Minda, I'll see you next time. Bob and Chris, if I may, for your parting comments, practical follow-up, if you don't mind. Can you give us some marching orders, IFI Global and the briefing report in our research department? What can be done to advance this? It's lovely having these nice chats and so on by webcast or in physical event format. But what can we do practically, including my little company, to advance the cause?
I'll take the first stab at this, Chris. So look, I think there are probably two things that I would highlight. The first is that I think asset managers in general need to figure out what ESG means for them, because ESG is quite subjective. And if they try and be all things to all people, there's an enormous amount of inertia to actually changing. The second thing I would say is, in order to move things forward, in my experience, is that it's actually about exchanging ideas and collaboration, rather than simply talking at people or trying to come up with metrics to measure them or things like that. So to my mind, the obvious way of moving it forward is to actually have some sort of forum where people can actually debate these things and have a discussion with a view to evolving the equivalent of common standards, or at least common approaches. Because if you don't have that, then you don't really have a meeting of minds. And that's what you really need to take this from being the people who are doing it here and there to actually be more of a movement across the industry.
Good idea. I think that's an excellent idea. Chris, last word of the day with you.
Well, I think what we've seen from investors is really a sense that this is the start of a journey. There isn't a right or a wrong answer. Whatever we do in this space, it needs to be constructive and contributive. We want to be proactive to help generate good outcomes. Where we're going to be in 5 years from now is probably quite different from where we are today. But what we are seeing is really a sense of needing to start somewhere. So what the relationship we have with our clients, they're asking to, okay, well, let's at least survey and conduct a threshold level of due diligence on all of our asset managers. So at the management company level, how many of them do not have a modern slavery policy? Let's have at least some basic core metrics across gender diversity at different levels of the asset managers that we've hired. Many other similar metrics. Similarly, start to look at the investment decision-making process for, to make sure that we're not going to be surprised and on the back foot with blatant, self-evident greenwashing. So really a sense of there is a threshold initiation of work that is required to at least get us moving with an understanding in the aggregate of what we have across our overall portfolio. But again, not necessarily with that dogmatic, an ideological dogmatism of really looking to fit everyone into a framework. It's really a case of, let me at least understand what I have. Where do I have things that are leading? Where do I have things that are lagging? And what's a plausible next step?
Thank you. That was excellent. Thank you all for your contributions. And I like very much what you just said, Bob, about the idea of a forum, which that is a practical, realizable goal to get to, and potentially something we can still do in lockdown through this particular type of technology, for example. So thank you very much for following us, all those of you who are still out there. We will be writing this up in the briefing report. We will be doing a number of different things to try and advance the cause either through the briefing report or through other aspects of IFI Global. and we will be doing many more of these types of discussions on a whole variety of subjects for the rest of the summer and going into the autumn. So hopefully see you for the next one. Goodbye, everybody, and have a good rest of July. Bye-bye.